Hello, Patrick Walchuk here, and what we're doing is we're going to do a financial analysis on a 6-unit building that sold in Central East Ottawa in the month of February 2026. So if you enjoy getting these videos, hit the subscription button, notification bell, and we'll get them sent out to you every month. So we'll pull this up on the screen, and just before I go through the numbers here, I made a couple of notes about this property because it's kind of interesting in that it was constructed in 2015. So by Ottawa standards in some of these older residential neighborhoods, that's really quite new. So it's, 10, 11 years old. So that's one interesting thing about it. Now, another thing is that it has 0 parking, which is not unusual completely for the neighborhood that it's in. So that has an impact on the value of the property. And the other thing is that it was a legal 6-unit and it had a non-conforming, which basically illegal, 7th unit in it. So the numbers we're using, and to the listing agent's credit, they did not include the income from that 7th unit, because when an appraisal company appraises the property, they can't include that income either. In case it gets shut down, the owner loses that revenue. So anyhow, we're not including that 7th unit income. So we'll get right into what it was generating, and we can see the list price on it was $3,150,000. It ended up selling for $3,075,000. It had a scheduled rental income of we'll call it $286,000. When we deduct to get down to the ERI, vacancy and bad debt, that gives us an ERI of $277,000. The stated operating expenses, we'll call it $50,500. When we factor in maintenance and management, 5% for each of those two categories, that gives us total operating expenses of $78,000. So it gives us a net operating income of $199,000. So what does that mean? Well, it means an incredibly high cap rate of 6.5%. And again, I'm just really astonished that a newer build that one would anticipate would not have any very limited maintenance required on it, maybe for as long as another 5 to 10 years. That's very high, Certainly investors want to get over 5% now, but that's kind of off the charts high. The operating expense ratio is what you would expect for a newer building, right? Because you don't have those maintenance costs. So this is really, really good at 28%. The gross and the net are what you would expect, kind of, at 11 and 15. Now, what we like to do is take a look at what down payment is required on a building in order for it to break even or have a slight positive cash flow. So in this case here, we couldn't go below 20% because that's a minimum required in order to purchase a multi-unit investment property like this. So we used 20%. So if the purchaser had a 20% down payment, that equates to $615,000. We can see what their mortgage is and what the mortgage payment would be on a monthly basis. When you take that out to a mortgage on an annual basis, the annual debt service, that's $155,000. So knowing those things, this building actually has a positive cash flow of almost $44,000, which is an ROI of 7.13%, again, which is off the charts. Very surprising for a new build in Ottawa. Thank you for watching.